So hi everyone, and thank you for joining us once again to our second panel in the first Virtual Industrial Real Estate Conference 2021 here with Faropoint. My name is Adir Levitas, co-founder and CEO of Faropoint. I'm excited to have this second panel dealing with last mile industrial real estate and financing environment. We got really special guests here, so I'll be happy to introduce them. I'll start with Miss Allison Gauthier. Allison is the Senior Vice President and Team Leader at Citizens Bank. She currently manages the institutional data center and the REIT teams. These teams comprise of over 5.5 billion portfolio covering top-tier commercial real estate sponsors in the private and public sectors. She has been at Citizens Bank since 2014. Prior to joining Citizens, Allison was a Senior Vice President at Bank of America on the institutional real estate team, where she managed a $1 billion loan portfolio. Our second guest is Mr. Nich Murphy. Nich is a Vice President in Eastdil Secured Industrial Equity Sales Group. In this role, he is responsible for the disposition of logistics assets with a focus on regional and national portfolios. Since joining Eastdil Secured in 2017, the group has closed more than 700 million square feet of industrial real estate. Our third guest, and my dear friend and partner, Mr. Ohad Porat. Ohad is the CIO of Faropoint, where he's responsible for the company's investment array, including leadership of the investment strategy, overseeing acquisitions, leasing, property management, and the go-to-market strategy across multiple markets. Ohad has closed over 100 real estate transactions, totaling more than 15 million square feet and over 1 billion in transaction value. Vadim Greenberg, our last guest. Vadim is a Senior Vice President of Acquisition at Faropoint. In his role, he is responsible for the company's acquisition array, including execution of the acquisition strategy across multiple markets. Previously, Vadim served as a real estate acquisition manager at Harel Insurance and Finance, where he was responsible for a deployment process of over 2 billion in equity across major real estate sectors in the US, Europe, and Israel. Guys, I'm really happy to have you with us. So, Nich, why don't you start with you? You got a great take on the market, and
Sure.
Maybe give us a little bit of your view of how the industrial sector weathered 2020 as a whole.
Yeah, happy to. Thanks for having me. So 2020, I think everyone realizes was a pretty strange year, and the industrial sector, really like all sectors, once COVID and Corona happened, saw some short-term pause, but industrial ended up being the main beneficiary of what was that strange year. We ended up the year with 225 million square feet of absorption, so that's close to all-time records, which is that, and that's 10% higher than 2019. 2019 was obviously also a very big year, so that gives you a sense for the type of tenant demand. A lot of that was sort of back end loaded. Not a lot happened in terms of leasing velocity in the first half of the year for obvious reasons. And then, with people stuck inside, they looked to e-commerce and they increased their adoption. So a lot of folks who never used e-commerce before, whether that was, typically the older generation that didn't come up with it, they were forced to use it. And so a lot of sales, which traditionally happens in a more, traditional sense, going to grocery stores and CVS, that sort of thing, shifted online. And so that there's a piece that Morgan Stanley put together that I reference often, but based on their math, that the pandemic pulled forward e-commerce adoption 2 years. So if we had stayed on our normal trajectory before that happened, it would have taken us 2 years to get to where we are today. Now we've given some of that back as some of the restrictions have loosened up, but if you look at how we ended the year and some of the stats that I quoted, it was the biggest Q4 ever. So it was 100 million square feet that got absorbed in that 3 months. And again, to say it again, it was 225 million square feet across the U.S. industrial sector. E-commerce is, like I referenced, was driving a lot of that, but that's actually only about 20% of that absorption. So there's a diversification in terms of who's taking space. And we, by all accounts, foresee that continuing into 2021.
Yeah, thanks for that. I did read, most things as well. And I remember one of the things that e-commerce share out of total retail changed from about 15% to 21%. That's about a 40% increase. And you said 2 years pulling forward. I saw some places saying 5 and 7 years pulling forward. And some of those physical stores that were shut down are not going to be reopened. And therefore, some of this trend is really going to continue with us. So I guess my question to you is how much of that tenant demand in the market during the second half of 2020 did you see related to e-commerce? And then what happens to those tenants that are not related to e-commerce? So we're going to see some softening in the market because some of those tenants are just not enjoying the e-commerce boom. What's your take on that?
Yeah, I think that 20% of overall absorption being e-commerce, I think that's a pretty good proxy just for second half demand. Because there's obviously some carryover from 19 into early 2020 for absorption, but a lot of the absorption was back end loaded. So no one was really taking space March through June. Well, I shouldn't say that. Amazon grabbed a lot of space in between that time. As I'm stuck inside and needing to shop online. But, I think that's a pretty good proxy, about 20% attributable to e-commerce. And then you've got a lot of other industries like home improvement, like healthcare that sort of similar where they saw an uptick in demand and they needed to take space quickly.
Got it. Well, Allison, you had a pretty interesting position during COVID. We had a credit facility at the time, which you're well aware of by chance. But it was not an easy way to figure out what's really happening in the market March through June. And from our standpoint, I remember banks didn't really know what they should do next, how selective they should be. And interest rates really dropping, and how should they, change the rates, if any? How did you see that process March through June and really change your strategy, as a commercial lender?
I think, well, at least I can speak for what Citizens did. We executed on any term sheets we had in the market. So we pulled through on, even if it was a multifamily construction, whatever, anything that everybody thought was going crazy, we closed. So that kept us busy March and April, May. And then we started thinking, okay, what is going to work? Where are the opportunities? Let's focus primarily on our existing sponsors, which is what a lot of lenders did. Those sponsors that have weathered storms before. And then we also looked at, because we do a lot of data center lending, we knew the growth in industrial was going to be there. So we decided cash flowing industrial assets. We do a fair amount of industrial pools and portfolios, and those have always outperformed everything as much as they're a little more work. So we were able to target some capital that way also.
Mm-hmm. So did you keep lending to GPs that you had a very good relationship with, even though if they were in lesser, in sectors that didn't weather it as good as data center and industrial?
If there was no market risk. So if it was buying an existing multifamily building that was already leased and the collections had been strong, then we would continue doing that. If it was a corporate facility, yes. We wouldn't take any lease-up risk, and we're still very hesitant to take that.
So I guess it's safe to say for a GP in a crisis, it's not the best time to look for new banking relationships.
It can be a challenge.
Yeah, especially if you're in a sector that you got some real headwinds to fight with. Mm-hmm. So I'll turn the question to you, Ohad, and during this period, in Faropoint we did buy 30 or 40 industrial warehouses, and how do you see from your standpoint? When did you think it's the right time to go back into the market because there's more opportunity than risk? How did you perceive that?
That's a good question. I think that back in March, when we've started to hear about the pandemic effects, that is some lockdowns and stay-at-home orders, then we started to feel, okay, how the economy is going to react to people actually sitting at home and not committing economic commerce to a certain extent. How will our tenants be able to endure these closures or these lockdowns or shutdowns or whatever? So we monitor during March and April pretty closely how our tenants are doing. We had at that time about 500 tenants in our portfolio, and we were talking to them, at least to the major tenants in our portfolio, on a daily basis, trying to hear, how are you guys doing? What's your projections? How do you see your decrease in sales? And I think within 60 days or so, it was not clear, but you started to see the trend that the industrial users and the e-commerce especially, and also the 3PLs, which are also doing e-commerce to a certain extent, some of them at least, they're not losing any business whatsoever, but more so they're starting to talk about, hey, can I get more space? Or I think I'm seeing some shifts in the market. And at that point, it was still a giant haze and question mark of where the market is going. But we started to feel comfortable that maybe, although it's not clear how things are going to end up, it looks like the industrial sector is going to be more resilient than we thought initially. And this is kind of where I think we took a 2-month pause somewhere there in March and April, but then in May, we've started to gear up. Okay, let's see, let's try to open up again for acquisitions and try to see. Not necessarily the entire market was doing the same. Sellers were trying to kind of figure out where they want to be, and like Allison said, having a deal with a lease-up risk, something that we were very reluctant to do at that time, even though we thought there's some positive tailwinds there as well. But it was kind of a little bit of a waiting game that kind of turned out to be fine. And I think coming June, July, we've started to see, okay, this thing is really progressing, and it kind of the effects on e-commerce and logistics demand in general is actually growing. Some of the deals were only materializing, like Nich said, only in Q4 or late Q3, and we've seen it also. I think Q4 for Faropoint was also a record quarter with about $75 million worth of acquisitions. But that was kind of from our take, how it kind of progressed during this year.
Yeah, that's interesting. I remember when that hit during March, beginning of April, we decided to open a virtual war room, where we looked at collections and tenants' status on a daily basis. And we were waiting to see every day. We came on the call and we were waiting to really hear bad things, because we didn't know how that's going to end up. And we saw the resiliency of the tenants. And then we looked into publicly traded REITs and saw that at the end of the quarter, collections were 96 to 99. And we saw that our portfolio, which is more consisted of last mile, was the same kind of collections. And we thought, this is not your ideal crisis. This is something else. It affects businesses not the way you think, even though most of the last mile tenants are not accredited style Amazon, but still you saw the strength of collection. And somewhere, I think, as you said, mid-May, starting June, we started to understand cap rates are not going to rise. And if they do, it's going to be really a low change. And from the other hand, interest rates are really falling down. So your spread, even without any change in cap rates, is becoming really attractive. And there was that specific deal I remember in Memphis, and that the cap rate was really attractive, and there was like a 550 basis points spread. And we said, you know what, pandemic or not pandemic, this is a deal that has to be done in terms of safety margins. And as that happened, and just like Allison said, we didn't think about opening new markets at that time. We said, okay, if we have plans to go now into Jacksonville or Louisville, that's not going to happen now. I mean, we need to make sure that we can take the risk on markets that we know how's the tenant demand going and the transaction volume and the liquidity. And so that was where we took it to. Vadim, I'm interested to hear, maybe you can share from your experience this in 2020. How did you see, if any, underwriting changing and maybe sellers' expectations as I know you talk to dozens of sellers each month. I mean, did you see that COVID sentiment rolls into lower prices, or, I mean, how did you feel that?
Yeah, definitely. I think that there was a very big change in the pricing and also in the available capital during this year. It started, obviously, everyone were concerned at the beginning, and there was uncertainty to some extent. But then once the industrial sector came strong out of that pandemic, we saw a lot of other players that weren't active before on the industrial side and were mainly active on the office side and the hotel side and the retail side, starting to bid on industrial deals. And we find ourselves with competition with new players that weren't there before. And not before 2 years ago, weren't there before like 1 month ago. And that drives pricing quite a bit. It decreased cap rates, obviously, because some of those players wanted to try and penetrate to a very competitive market and were, and Nich could support that, I guess, from his side, but those buyers were willing to pay higher price, even above market, just to get access to the product, because they felt that once they gained that access, the next deals will be easy. But I can tell you that it's usually not the case. It's never get easy, and but definitely much more competitive than it was before.
Yeah, and I can jump in there
go ahead.
Real quick, because that's absolutely true. But a lot of what's happened on the capital market side is, think about if you're an investor in real estate and you can invest in major food groups, office, retail, hotel, industrial, multifamily. A lot of those sectors, save for more opportunistic style of capital, are off limits. Like, you're not going to go buy a core deal in office unless it's leased for 15 years to Amazon. So that's shifted a lot of the capital from those other sectors, and they're now really just focused on industrial, like all types of industrial, and selectively multi, depending on market and location. So that's driven a lot of real estate capital into the space. We're even seeing groups like infrastructure funds that have a really low cost of capital. Logistics is obviously it marries in well with what they're trying to do.
Infrastructure funds. That's new to me.
Yeah, I mean that's we're having a lot of conversations with groups like that have raised money in that sector. But logistics, obviously, you're directly tied to infrastructure like the interstates, and maybe a building that's rail served or tied to the port. And so it's just, the upshot is there's just a lot more money chasing basically the same amount of deals in the industrial space. So there's a supply-demand imbalance that's driving cap rates. It really just, we talk in terms of cap rates, but it's really just returns in general are coming down in the space. And it's supported by a lot of those operating fundamentals, right? We had a recession in 2020, and it was one of the biggest years on record for industrial. So you look at that and you see what it does for rent growth, and people are starting to continue to push chips in on industrial. And then Vadim, I think you were touching on this, but there's also new operators. That's like the true capital, call it more LP style capital. There's operators that have only done office their whole careers, and they're seeing they've got a little bit more time on their hands, right? That market's not as liquid, and their capital partners are telling them, hey, we're trying to grow an industrial or get a footprint. And so we're seeing more people pop up and spend more time in the space.
Allison, do you see that too?
Absolutely. I think, Nick's correct. There's way more interest in industrial. It was typically, we would usually see the life insurance companies would do the large existing assets because they could price so much more competitively than a bank. and the local banks would do the smaller flex office. It just didn't fit the bank's capital structure. But now more of our customers are looking at industrial. It's a little more, the banks, that's where they can put their money because it's performed and it continues to perform. And I think with e-commerce and other factors, I think the mid to longer term is also positive on industrial. So. Got it.
What do you wanted to refer to?
Yeah, there's one deal that may be worth mentioning that we were engaged in March, I think. Nich, you brought us this deal that was an industrial portfolio in Cincinnati. It genuinely just came to us by Nich beginning of March, really the worst time ever to buy multi-tenant industrial. Also evaluate a multi-tenant industrial portfolio. And we were engaging at that time at about 38 million. And I just got it. I just saw it yesterday published that it was sold last week for about $51 million. And nothing materially changed in occupancy there. But I think it kind of showed everything that we are talking about. One, it showed the increased demand. I think the buyer is a fresh new industrial buyer. So you see the demand from new players. You've seen the overall acceptance of this asset class, saying that it stood up a pandemic pretty well. Tenants were not lost. Collections were as they should be, even in normal times. Then it gave a few points, I think, for the industrial backwind in general. And you could really see it in this kind of a portfolio transaction.
Yeah, I should have mentioned general comment, but on that point, pricing in the space is, pretty significantly surpassed where we were even pre-COVID, which was obviously still a really good environment. But again, all that new capital and obviously the debt capital markets, I like to call it a circular reference where the lenders have fewer places where they can place their money, right? They're just naturally more risk averse. So industrial makes a lot of sense. Operating fundamentals are good there, and they have been historically. So lenders are leaning in on their terms to place money in the sector, and so buyers can pay more. Right, that component of the capital stack's cheaper, so they can then lean in when they're buying something.
That's interesting. I think that it's not only from the capital market standpoint that there's more demand, and it makes that imbalance that you mentioned, but it's also when real fundamentals are changing. The need to serve consumers has really changed. The amount of essential products that are being expected now to get to your front door. The fight between the big e-commerce companies and retailers really on the heart of the consumer. That's changing too. And I think one of those, of course, Amazon is the pacemaker and the leader, especially what we saw in 2020 for last mile facilities, has doubled its amount of last mile facilities from 160 to 320. And they went out and said they're going to do 1,000 more of last mile facilities in the next upcoming years. And I think Vadim and Ohad, we just saw a deal in Philadelphia where Amazon took a last mile facility that we would think is non-functional for Amazon, as we see them usually, even in last mile facilities, using 22, 24, 32 clear height, taking an old 1960s, 1970s building 17 clear height and signing a lease for 12 years. So I'll ask you, Vadim, why do you think they would really take on such a lease? Is this lack of supply? Is this the functionality is enough for them? What's your take on this?
I think there is two sides to that story. The first side, and this is kind of the obvious one, this is the lack of supply. Very hard to find well-located properties in those areas, such as Philly, such as Dallas, such as Atlanta, the growing cities, and the gateway cities. And for them to when you're already finding something like that, you want to secure that because in the end of the day, it serves your term. It serves your purpose. So I guess this is more the obvious side of that. And the second side, in my mind, this is probably speculation because I'm not working at Amazon, but I'm trying to to think the way that they think. they have a lot of orders or a lot of things to provide in a very short time frame. And if they need a space, they need it right away. Usually they need it, they understand they need a space, and then they try and go and look for a space. And if there is no available space, this is their only option. They will still take it, although it's not as they wanted, as they might want it to be. They might want it to be as with 32 clearite or 28 or whatever, but it's still functional enough for their needs, and this is why they are willing to take it. And even for long term, because location is not changing over time. It might, but probably it's going to be still a good location to serve the last mile needs.
Mm-hmm. It reminds me when we tour one of our Amazon facilities, and we came in, I think it was 2 p.m. into the warehouse to tour, and it was empty. And we thought, oh, nobody orders in e-commerce. And then we asked the store manager, and he said, everything's gone. I mean, if something needs to be same day, it's gone by 2 p.m. Otherwise, it won't get to your doorstep by 5. And therefore, those facilities don't really need that ceiling height because it's in and out. And it's interesting because the functionality of those warehouses, the ugly, older warehouses, they were treated, and you know that well, Nich, and interesting to see what you think about that. It wasn't what it is looking at today. When you see an old Fulton industrial warehouse, 40,000 square feet, that's not 2 years ago, 3 years ago. That wouldn't be, oh, it's so cool. It's a micro-fulfillment center. It's a last mile center. Those buzzwords really give a different name to that. And I don't think it's just capital markets. I also think it's fundamentals. What do you think?
Yeah, no, I think it's all good points. Yeah, for that style of building for Amazon, the functionality of the building isn't as important as the location, because what they're trying to do is fully integrate all of the deliveries over time. So their typical model historically has been they get it to a certain point in their supply chain, and then they basically hand it off to FedEx, not anymore, but FedEx, UPS, USPS, and they do the partial delivery to your house. That piece of the supply chain is very expensive. It's estimated it could be, $2.50 per package, which if you think about, individual package, it's expensive. They're internalizing all of that. And so it's a bit of a land grab for them. They need these really, tucked in locations close to a lot of their consumers. And Amazon, I think we all know this, but Amazon has a ton of data on everybody. There's a lot of Prime members. And so it sounds weird to say it, but the product flowing through this warehouse, they sort of know what is going to be ordered before it's ordered. They can look at particular areas or zip codes, and they know, there's going to be, 30 tubes of toothpaste ordered today. And so each individual building is sort of specific to a particular zip code or area. And so that's why, like you guys were saying, the clear height's not important. And really the building functionality, the building itself isn't as important as it is. They need lower coverage sites where they can park vans. I'm sure everyone's seen these Amazon Sprinter vans now. They're used to seeing FedEx and USPS or UPS and USPS, which obviously are still out there, but Amazon's starting to do all their own deliveries. So they need areas to park the vehicles. So what we're seeing is lower coverage, sites where they can park vans. Clear height doesn't matter as much. Products flowing through the space. And if you can check some of those boxes, Amazon's going to be very interested. Adir, you're right. I mean, they're basically just starting to roll out their last mile prototype, which is called AMZLs. They're trying to do a lot of build-to-suits, but it's hard to find 30 acres of close-in land in a lot of these MSAs. So they're taking second-gen facilities and rehabbing them, and it still works for what they need.
I think that niche of smaller warehouses, what we like to call last mile or urban distribution facilities, still has maybe personally, I think a pretty interesting opportunity because the capital markets, the large institutions, don't really go on and buy those 40, 50,000 square feet facilities, and they look for that portfolio. And the competition you're seeing, when you trade those portfolios, if it's with overseas investors and institutionals. But nobody really takes the time really to aggregate those smaller warehouses. And, and that's why we try to do that, because we feel that cap rates are not compressed as they are. The opportunity, the fundamentals are the same. It's part of the supply chain, but the capital markets pressure is still lower. And we see that still as the opportunity. I want to ask Allison, now that we see rates really, Treasury is still very low historically. Mm-hmm. And, I'm thinking late 2018, we took really like 200 basis points more in our loans. The environment was different. How do you decide if you could really let a sponsor absorb that difference in spread? I mean, how do you price that out? How do you think about that? Because it sounds like even though there's a lot of demand from the capital market side and cap rates are going down, interest rates are not always going down as much as the spread has went down. I mean, how do you see that? And I know it's a customer by customer thing.
Yeah, it is. It's there's a range of pricing for every asset type, and it's based on sponsor, leverage, cash flow, all the normal fundamentals. In terms of why it hasn't really compressed that much, I think it's just there's so much uncertainty in the world. And as I think Nich may have said, banks are somewhat risk adverse, probably the most risk adverse. And so uncertainty brings cost. And it makes banks have to carry their capital in different ways, provisioning for losses. And so that our capital just gets more expensive so that you don't get to experience the same compression of spreads when there's so much uncertainty in a market. And then the floors, as you mentioned before, the floors, right in the beginning of the pandemic, they were probably 100 basis points easily across the board. And as things settled down a little bit, they've come in, but we're still seeing 25 to 50 basis points on floors. Whereas before the pandemic, we could put it. Yeah, we put a zero floor in just to make sure we didn't have a negative interest rate. And sometimes you could get 25 basis points, but it wasn't common. They're very common now.
Nobody talked about it before, negative interest rate.
Negative interest rates,
yeah,
right.
I mean, nobody thought about it, or interest rate at zero. I remember that.
Zero, right.
We had a zero flow in a facility. We didn't even know that. Nobody imagined such a thing can happen. Right. One more demand driver that I think is interesting. I read about one of the researchers, a CBI research that was talking about reverse logistics. And I think that's an underestimated demand driver for industrial. And the reason is it's really 30% of our packages are being returned. Some of those retailers out there like Zappos, that's part of the strategy to bring you shoes so you can buy shoes and send them out. And 30% of that product going back, this thing has to go through something somewhere. And if you have a last mile facility that is the products are known exactly what they should be, just as Nich said, Amazon knows most of what is going to be sold because they have their prediction models. What happens if you get a shirt and you don't want that shirt anymore? You don't want it because you just don't like it, or maybe it's not a good fit. Maybe it's defect or any other reason. So companies just don't know how to take that thing from you and where should they send it to. And in that research, the main claim is that those last mile facilities, those that we talked about, their functionality is good, but not as good as the modern with the lower clear height, are really, really suitable to get that reverse logistics back, because when you don't know what you're going to collect from the consumer, how do you know how you're going to stack it? I mean, how do you know how you're going to sort it? Do you take it back to the supply chain bloodstream, or do you send it out to disposal? And I don't know if how much we saw in the market, but maybe Vadim, what can you say your take is on that? I mean, out of and you have a lot of tenants that you see. How many do you really see that phenomenon coming in? Because if it's not, we're going to start seeing that demand really coming in, especially as e-commerce sales arise.
Yeah, I think that first of all, we need to understand maybe a bit the difference between the last mile product to the more bulk product or the big boxes. The big boxes has essentially one use, to distribute product, fulfill and distribute. While last mile have multiple use. It's, last mile, it's a magic word, but essentially if you try to break it down, last mile could be a yoga place. It could be a gym. It could be whatever business you might, it could be a showroom or whatever business highest and best use is how we call it in the real estate industry. So just based on that, you have higher potential demand from other tenants that are not essentially on the e-commerce side. They can do some other stuff not related whatsoever to internet or e-commerce, or just because the location works for their need and the immediate residents are using that space for whatever they are using for. So if I'm looking, on the deals that we are buying, and also other players as well, they might acquire last mile facility, but it doesn't mean that the tenant will do actually e-commerce or last mile. So if you try to break down those tenants, you're gonna see a lot of different tenants that not necessarily doing last mile or e-commerce, but out of the tenants that are doing e-commerce, I do think, and I definitely agree, that reverse logistic is just at the beginning of it, because a lot of those players still, I wouldn't call it fail, but I think educating ourselves, themselves on the way to better understand the trends and how is it gonna work. Though the big guys, the Amazons, they have their big data, AI, whatever prediction model that they're using, but the smaller guys don't really have it, so they need to adapt and learn on the way. So just to summarize, it's very hard to understand what will be the tailwind for that, but it's very easy to understand that there will be a tailwind for that.
Mm-hmm. I think you can explain.
To jump in quickly, whoever can figure that out, reverse logistics, will be a very wealthy person, because it's clear that, even Amazon struggles with it, right? Where they've now partnered with Kohl's, I think, just to give people sort of an outlet to go, obviously go physically to somewhere and make the return. To try to send something back upstream, you got to take a bunch of different stops for a package to arrive at your front door, and then try to reverse that and get it back to where it needs to be. It's incremental cost, and for some of the products we're talking about, the margin's very low to begin with, and so that's often why you hear e-commerce is not a large margin business. That's a big component of it is the reverse logistics.
If to judge according to what's happening in my house, then I think it's more than 30%. But it's like Nich said, it's how to figure out reverse logistics. I think it's also how to figure out last mile, because even if you look at Amazon, which is clearly the leader in that arena, I think we bought one of their first experimental last mile facilities in Memphis, and that was only 2 years ago. Only 2 years ago, that was their experiment in trying to bring direct-to-consumer building, and now they're talking about putting 1,000 of these, or even more so, in the next coming years. So if Amazon is still figuring it out, it clearly shows that a lot of the other companies are still figuring it out. And there's some fundamentals that we are starting to learn that are more relevant than others in choosing the right location. And like Nich said, I think land has become much more important, additional land, than it used to be before, because when you look at a last mile and a place that goes a lot in and out, then you need a much greater interval between. It's not like 5 trucks a day type of facility. It's a much more heavier operation, and because of that, location becomes more important. It's not just important to be in a good industrial park with good access to rail. It needs to be main and main sometimes, especially when you track those Amazon facilities, because they want to be as close as they can be to the centers of population. And then comes the question, okay, what about other fundamentals like clear height and so on? So you mentioned the building in Philadelphia, and that's what we see. At the end, those buildings are getting emptied on a daily basis. And if they do, they don't need to stack high. There's no long-term inventory management for those facilities. So that's kind of the trends that we see. We see more emphasis on location that's being driven by proximity to consumers, more land to building ratio, and less kind of what the clear height should be.
I know in the past, maybe 20 investment committees we had during 2020, and saw really buildings in many markets, from Houston to New Jersey and Atlanta, and second-tier markets like Memphis and Cincinnati. And we see price really differ a lot. We see the $100 per foot in a rich market like Houston, and we see the $30 and $40 per foot in Memphis. At what point do you say, this is a red flag, I'm not willing to pay so much per foot, just doesn't make sense? What are you thinking when you're looking at a price per foot that's becoming too rich?
I think that it really drives from the location. I've seen a deal that was traded in Seattle, I think early this year, for over $550 a foot. It clearly makes sense to someone to pay those numbers, and I think that kind of what drives it. At the end, when you value the location so much, you are willing to pay more than the replacement cost per se, or more than the just market or sub-market average. It's becoming the asset class becoming more like retail. It's how much am I willing to pay for this corner, rather than I just need to have a good warehouse in a logistics park. When we buy assets, we always track, okay, what should be the comparable replacement cost, how much land is available in the vicinity of where we're trying to buy the assets. Because if there's no availability of land at all, then it's really hard to determine what is the actual replacement cost for a building like that, because it cannot be replaced. And another phenomenon that we see, in when you search that, is that communities, especially infill communities, where you see population growth, they don't want to have industrial buildings and trucks getting into their backyards. So even if you have tract of land to zone it to industrial, or to try to approve a project, you see that process sometimes take a lot of time or not really happening. So there's a real chase about getting those corners, and kind of everything relates to this story of the Amazon in Philadelphia. It's hard to build a last mile facility right now in Philadelphia because of available land. Entitlement process takes a lot of time, and Vadim touched on it. And it's just, it's hard to find the right place.
So with that notion, I'll ask Nich, do you see redevelopment of malls? Do you see multi-story industrial facilities submitting plans? I mean, do you see creative ways of generating more demand in infill locations?
Yeah, I mean, so the mall or retail thing's been talked about for a couple of years now. We've seen it actually come to fruition in a couple of circumstances where you've got a one-off Costco or a Lowe's that's vacant that gets readapted to an industrial use. The challenge with that stuff is municipality doesn't really want it, like Ohad was saying, like you're going to get a lot of neighborhood pushback. The municipalities would prefer the retail use, where you get sales taxes derived from retail, where you don't necessarily get that in industrial, and it's just perceived to be a dirtier use. So is it possible? For sure. Like it's happened. There was a deal in Southern California that was an old Costco, and it was fortunate because it was in an industrial overlay, and they got a variance for retail for the Costco. And so it was able to revert back to industrial use. And that deal traded, Amazon took it and traded sub 4. So there's tenant demand, and clearly the capital markets are fine with it. The question is, how do you can you get to the real estate is the main question. So I think that it's possible, but it's not easy. And then full scale, like a redevelopment of a mall is sort of it's a can of worms for a lot of the same reasons. But to try to redevelop, like leave the existing structure and redevelop a mall, I think that's very challenging. But there's been several circumstances where there's been a defunct mall and developers have bought it and just raised it for industrial for the right location. So that's, not saying anything earth shattering, but that's happened in the past.
Allison, did you see any of your clients asking or trying to get finance for such redevelopments?
We've, like Nich said, it's been talked about for a while. We've heard, malls have to have some reuse, and typically a mall has good real estate. It's usually located near an interstate and close to the population center. But I have not yet seen a redevelopment of a full mall. And I think Nick's right. It would probably have to be raised before you could. So it would have to be truly an infill location where there was no other land opportunities.
I think that also other limitations are prohibiting from happening. It's the city that doesn't want that to wreck the beauty of that area.
Right, the trucks.
The trucks, taxes. It's just not. People don't want to go out of their homes and just see an industrial facility, even though they look pretty nice, the new ones. But it's not the malls anymore. And I think that stats show that only 14 million square feet was redeveloped of malls. And most of it was not used the same structure. It was they wreck it down and they build something new. And where we do see that, where it's not wrecked down, it's usually just used for the parking spaces. We see many of those in Vadim and Cincinnati. So Vadim, I'll ask you a question maybe, towards the end of our session, thinking more about the future. We see tremendous hype and demand for capital markets and tenants in a few markets. If it's Southern California and Dallas and Atlanta and New Jersey, why do you think that's happening for those markets specifically? And do you see that going on for them for the next 5 years?
Yeah, so in the end of the day, it's all driven by, on a bigger scheme of things, it's all driven by population growth. The cities that are growing faster. There is also, by the way, a correlation between the density in terms of population per square mile to the actual rent. If you compare the population per square mile in California and the rents in California, you compare it to Atlanta, you're gonna see more or less very similar difference between the rents, as you can see between the average population per square mile, the density population per square mile. So I think that those cities will gain the most out of the last mile in those cities will gain the most out of this population growth. But this is one side of the story. The second side of the story, those are the cities that are the lowest cap rate, with the lowest cap rates, and there is a reason for that. This is exactly the reason. I just heard probably a month ago, and I'm not sure even if it's public published. I just a word that's going through the brokers that there was a deal that was publicly marketed by CB that were closed at a cap rate that begins at 2, which is crazy. Crazy cap rates. No one even thought that it will get there, but it's getting there. So I
heard Bruce Flatt, Brookfield's CEO, saying a few months ago that as interest rate came down, he said, this is going to be Europe. Just wait a few months and cap rates will be in the 2s. Maybe that's the beginning of it.
Yeah, maybe, no one knows. It's very hard to predict that, because if you would ask me 2 years ago where the interest rate will be, I would not tell you that on that level, that's for sure. But per your question, I think that the gateway cities with the population growth will gain the most. And also in those kind of locations, you need to be smart on understanding the market dynamics. You need to be smart on understanding what is a good micro location versus not as good micro location. And you had mentioned that as well as to replacement cost. Replacement cost is something that's very important that to look on when you are acquiring a building. But at some places, such as LA, for example, replacement cost is just a theoretical discussion. It's probably could not happen because there is no available land at those locations where the rent growth is higher than 7, 8, 10% a year sometimes. So I think the dynamics are changing between the cities and the locations, but overall, the big cities with the population growth will gain out of that.
No, even though those cities are really growing so much, I think that we see some of the headwinds for industrial also happening in those same cities. And Nich, you and I talked about that in the past, and maybe you can share a little bit of your thoughts. There's some oversupply, maybe not immediately, even though I think Houston is one of those areas people need to be more careful. I mean, do you see oversupply as a prominent risk for bulk distribution in industrial real estate?
Yeah, I mean, in pockets, and to go back to the previous question, why Socal and Northern Jersey perform so well, it's because it's really hard to find land. I mean, whether it be for bulk product or something that's really infill, there's not many outlets. There's not many for low-cost options because it's so dense in those markets. So, in Northern Jersey, a lot of people have had to go to Lehigh Valley, Eastern PA, and that's sort of been the low-cost option, but that's also gotten really tight. So that's what's driving rent growth in those markets. Where there could be a little bit of softness, and we've seen it in a market like in Atlanta. It checks a lot of boxes. It's a huge MSA, certainly considered a primary market, sort of the hub of the Southeast for industrial. And the population, it's in the Sun Belt, population growth story is great. A lot of corporate reloads and just a lot of population growth here. So that being said, if you look at Atlanta on a map, I mean, once you get 30, 40 miles outside of Atlanta, there's some land. So the light industrial, infill light industrial sort of last mile segment is, I would say, relatively secure from oversupply because it's hard to find sites. A lot of developers don't really want to spend a lot of capital too. It's a tougher use of time. Return on time is pretty low on something like that. To build 150,000 feet, it takes the same amount of time to build 1 million feet. It's a bigger development fee for the developer, and it's a bigger equity check for the capital source. So people are letting sort of those capital markets, the capital markets drive those decisions. And so there's been pockets like, not to pick on 85 Northeast, but as you go further up 85 in Atlanta, you're heading towards South Carolina. There's a ton of land up there. And so you're always going to be able to find a site to build 500,000 feet to 1 million feet. And that's very much a regional distribution location. So there were times over the last, call it, year and a half where a lot of developers built pretty similar products, call it that 500,000 to 1 million feet, commodity locations, like really similar locations, not differentiated. And the tenant demand waned. There just weren't a lot of tenants in that particular submarket. So I think you could see that since changed. I think by the end of the quarter here, the majority of that stuff may get leased, but there can be softness in some low barrier to entry submarkets, and I'll be less worried in the short and medium term about just like serious headwinds in general in the industrial space, but I would just say it's a little bit more located to or tied to micro location in some.
Last topic for you, Ohad. I guess you can't really have a conversation in today's investment world without really talking about ESG. And we see that responsible investing is something that is becoming integrated in the institutional investors' decisions to make an investment with a sponsor. So interested for you to share with us, how do you really see, let's talk more about the environment in the day-to-day operation, if it's green energy or any other things that you would think about when conducting business?
It's a vast topic, and like you said, I think that's kind of as much as people like to say less mile, people like to say going green or ESG. It's definitely becoming more than a buzz, though. It really drills down and trickles down, I think, to what we see in the field. And companies, bigger companies, they take it pretty seriously. For instance, we own a facility where Nike is a tenant, and Nike there, they perceive themselves as a going green type of company, and they put a lot of ESGE type of improvements, whether it's solar mushrooms or solar panels and climate control improvements and kind of a natural light into the buildings to improve its consumption. So you see that all throughout. You don't see that a lot in the last mile or light industrial type facilities. For the main reasons are these buildings were built in the 60s, 70s, 80s, 90s. And back then, the bones could care less if it's efficient or not. So people try to do, okay, so what can we bring, or what value, or what environmental value we can bring to the buildings? So I think the immediate suspect that comes into mind is using solar energy. And what you see, especially in the New Jersey area, and you see that a lot also in California, the two states that are very supportive and subsidizing solar to a certain extent. When you fly over New Jersey, you see most of the industrial roofs have solar panels on them. And this is something that we at Faropoint are trying to do the same and offer our tenants the ability to go green and go clean energy, and to not to our surprise, but it's always nice to see that even if you don't offer your tenant a giant saving in cost, tenants want to be aggressive on going to clean energy, even if it costs the same money, because companies, small and big, are trying to go more environmental conscious. So I think that's a trend that will probably trickle down from the bigger ones, from the Nikes and the Amazons that they really put it out there, to even smaller companies. They just want to do the right thing, and when in places where it makes a lot of economical sense, then even more so. To name a few other than just solar, what we do is that we take every building that we have and replace the lights immediately with LEDs. So that is something that also improves it a little bit. We take good look in the building systems, whether it's HVACs or heaters or stuff like that, and try to see if we can put some more convenient, less messy systems to make a win-win. Less consumption for the tenant and more kind of a green signature for our efforts as well. So just kind of to sum it up, you're starting to see it more and more. It trickles down from the bigger companies to the smaller companies, and it's definitely a thing that will be discussed, I think, in the next